Good evening, everybody. It is Sunday, July 20th, 2025, and in today's video, I'm going to be covering swing divergences or SD. So, this is a concept that many of you guys should already know. This is a remake of the previous video I've already made for swing divergence, a more, I wouldn't say refined way of explaining this, but a more detailed and more straight to the point video. Not enough fluff in this video. There's no fluff actually. Just giving you guys straight and letting you guys go ahead and do the rest of the work, meaning forward testing, back testing, and asking the questions yourselves to unravel swing divergences and the world that they can reveal. So I'll be going over a few topics, showing a few examples, and I'll also be going on the trading view charts and showing you guys how swing divergence looks like on real time, right? So some foundational information that you guys are going to understand by watching this video and by hearing me talk. So number one, what is a swing divergence or a SD? Significant highs and lows, SDs in power of three, and understanding how to implement them. So these are all topics I'll be discussing in this video. I know a lot of you guys might be surprised by me including power of three in this. And I don't mean power of three as in like, oh, like, like standard deviation power of three. No, I'm simply just talking about the normal accumulation, manipulation, and distribution that power of three provides, right? Which is just a basic understanding of power of three. And I'm going to explain on how if you incorporate swing divergences, power of threes will be very easy to spot. So ideally, you'll be trading quarterly theory using this model. But if you don't trade quarterly theory, you can still implement them, right? So we'll start off with the first slide. Understand before utilizing what exactly is a swing divergence and the basics and importance of it. So a swing divergence, better known as SD, are a simple concept derived from a quarterly theory concept called TPD. So before I continue further, this is not like TPD in terms of the time frame alignments and all the restrictions that TPD has. SDs have their own restrictions that are different than TPDs. I highly suggest, before I move forward, if you're going to watch this video and implement these, please watch the time frame alignment video alongside with watching the open and close divergence video, because it incorporates PSPs and you're probably going to be using PSPs for swing divergences. Right? So swing divergences are a more liberal way of trading soups. That is the most basic way, the most broken down way I can go ahead and explain what a swing divergence is. You're basically just timing a soup. If you'd like to, if you want to wait for more confirmation, like a swing or a CISD or an imbalance to form, you can absolutely do so. They both help. You don't have to wait it to form. You can also just soup the high. But again, souping the high comes with its own risk. So what exactly is a swing divergence, right? A swing divergence is when one asset class takes the lower high of the previous candle, preferably a PSB, it doesn't have to be one, whilst the other asset or assets fail to rate the higher low. So again, a swing divergence is when you have basically a two bar. If you guys trade quarterly theory, you know exactly what I'm talking about. It's when you have a two bar sequential or a two bar SMT, not sequential. Ideally, it will have sequential at some time frame, and I'm going to explain that in a few. But a two bar divergence that hopefully has sequential attached to it and hopefully soups a PSP, right? So the importance of swing divergences. Swing divergences are simply just another form of a Kraken correlation that can be utilized for analysis or entries. Now, let me explain something with this. I use swing divergences simply for analysis for any one that forms before market open. I use them for entries for any one that forms after 9:30. I really don't like entering off of swings alone. If I have other confluences, which I 99.9 of the time have besides just a swing divergence. Honestly, just even 100%. I've never taken a trade off of just a swing divergence, really. So if there's a few more confluences, I'll probably enter off of it in pre-market. I haven't entered pre-market using swings in a very long time. I usually have other stuff that gives me confluences for price to go ahead and deliver. The importance of a swing divergence comes from the clarity it provides in price. Once a higher time frame swing divergence is in place, your goal is to utilize your quarterly theory or ICT concepts to refine an entry off of it. Now, you don't have to use the quarterly theory alignments or the quarterly theory or ICT concepts to get an entry off of this. And you can use your own little magic thing that you have. But to be honest with you, the best and the highest probability entries and setups are going to occur when you have a QT entry model off of it, right? So anything related to QT, it's best you stick to quarterly theory. And if you want to use other concepts like maybe ICT, you can. But again, QT and ICT they go hand in hand. So I suggest just sticking to your quarterly theory entry models regarding sequential SMT, and then using your IST, maybe CISD or a imbalance to go ahead and enter a trade off of. Understanding what a swing divergence is, right? Identifying a swing divergence probability can easily be found by utilizing sequential SMT. So as I mentioned before, you don't have to trade quarterly theory to understand swing divergence. It's basically just an SMT amongst a high and a low. But again, most people think of SMT in a different format than others, right? When I put SMT amongst let's say a QT trader compared to an ICT trader, an ICT trader would probably think an SMT would be from an obvious high or an obvious low. Very few times would they consider a 2-bar a SMT, right? Or at least the basic ICT traders. The more experienced ones will definitely count it as an SMT at some type of time frame, right? So how do you identify the highest probability swings? It's simply by just utilizing the sequential SMT that you have at hand. So in this case, if you have a sequential SMT that creates daily cycle like we have right now, so like I mentioned before, if you have a sequential SMT like we have right now on this chart, 4 hour swing divergence, daily cycle sequential SMT, right? You can easily anticipate a reversal, right? In this case, a lot of people think that we only have one cracking correlation, which would be the daily cycle sequential SMT. Well, the daily cycle sequential SMT also creates another one, which is a swing divergence, right? Which, if you've seen the TPD videos, this should make sense to you, right? So probable high and lows. So this is probably the most important part of this entire video is the probability of highs and lows that present, right? What makes a swing divergence high probability, right? I've already mentioned the sequential SMT is going to give you a solid base, but I'm going to let you know right now, the highest probability swing divergences are going to come from the high or the low of the previous quarter. Now, there are certain alignments, and if you look at the previous slide of me looking at the 4 hour and the daily cycle sequential SMT, you will understand where I'm going with this. There's specific alignments you would ideally like to follow for this, right? So being able to identify probable highs and lows comes from the quarters themselves. The highest probability swing divergences simply derive from rating a higher low of the previous quarter. Remember that to identify swings, you will need to use the ICT MMXM/QT alignments. The reason why I mentioned the ICT MMXM QT alignments is because, as I mentioned in the previous slide, 4 hour swing, daily cycle sequential SMT. If you look at what the daily cycle sequential SMT correlated time frame is, you will understand what I mean by the MMXM alignments, right? Now, a lot of the times you soup a PSP. So if a PSP is being souped, you can utilize the QT alignments alone, meaning if you have 90-minute cycle sequential SMT, you can simply just look for a 5-minute PSP to be souped, right? And then continue on off of that, right? Remember that swing divergence will not signal a reversal. You need to look at other assets to identify a reversal point in price. Remember, price will reverse when every single asset has met its objective, okay? A lot of the times people see, oh, YM's mooning, NQ's consolidating, I want to short NQ, and they get chopped out for 10, 20, 30, maybe an hour, maybe 2, maybe even 4 hours until YM hits its respected drawn liquidity. And then when it hits its drawn liquidity, or its POI, NWOG, true day open, imbalance, whatever it may be, then you see NQ and ES sell off, or NQ and ES hit their objectives as well. Remember, QT involves 3 asset classes, so utilize them. Not just one, not just two. Of course, there's one that's more correlated than the other one, those two being NQ and ES, but use YM as reference in terms of looking at premium discount and as well as PSPs. So example, and I'm going to show this example in the actual trading view chart and not really here on the WAP, because I want to go ahead and, or not on the WAP, sorry, on this PDF to show you guys exactly how it looks like. So here you go, right? So this is daily cycle sequential SMT. As I mentioned before, you're going to be utilizing your high and low of the previous quarter. So this is Q2, right? This is Q2 from 12 to 6, Q2 high up here. And this is your 4-hour swing divergence, right? From 2 a.m. to 6 a.m. we have a swing with ES and NQ. We go ahead, and YM as well, where NQ raised the high and ES and YM failed to do so. In that process of us doing that, we end up creating sequential SMT. In this case, daily cycle sequential SMT. Remember what I mentioned about the alignments. Watch the time frame alignment video. It's super duper important. You have to watch it. It's very important. Okay, so daily cycle sequential SMT, 2-bar, as you can see, swing divergence with 6 a.m. to 2 a.m. We take out the high at 6 a.m. We fail to take out the high for YM and ES. Then you have your sequential SMT form, right? So in terms of power of 3, you're going to see me reference it now. If you're a power of 3 trader, think about power of 3 on the 4-hour time frame. Right? This is 6 p.m. open, right, or 6 a.m. opening right here, meaning everything from here to here was straight accumulation. Go ahead and put this here. This is straight accumulation. Anything above this old high would be considered a manipulation, right? This is going to be your manipulation zone, right? So yes, this can be considered, this impulsive move can be considered a manipulation as well. Anything above this old high is manipulation, in which we create daily cycle sequential SMT, and you look for an entry above the old high or with a lower time frame PSP entry model to then reverse back down. Now think about this in the 4-hour time frame. This is your 4-hour chart, right? Right here, 6 a.m., right? 6 a.m. open. Go back to your 15-minute time frame, and what do you have? Accumulation for almost, or basically 3 hours. And then right exactly the 3-hour mark, we raid the high, manipulate over the high, create daily cycle sequential SMT, and then we see a reversal point back down to our objective sell side liquidity that we have here from previous day close, and then we raid that low, right? It's a very obvious, Judas and then power of 3 model coming down short. All you have to do is just trust the power of 3 and trust the process regarding swings and let price do the work. Right? You're simply just clicking the button and price is delivering to its objective. So let it do so. Show another example here where we have this on the hourly time frame. So this is more of the PSP model, right? This is a bullish PSP that gets souped, right, at 9 a.m. The bullish PSP gets souped at 9 a.m. Notice how ES fails to do so and how NQ and YM both do it, right? So NQ and YM both raid the 8 a.m. high at 9 in the morning. ES fails to raid that 8 a.m. high. And if you look at the lower time frame, again, look how I'm referencing the 1 hour, and look at the time frame I'm not going to go to, right? We have the 1 hour, and then what's created at the highs. We end up creating at the highs 90-minute cycle, 90-minute sequential SMT, right? So with 90-minute cycle or 90-minute sequential SMT, what ends up occurring? You have your 1 hour swing, your expansion leg, retrace back into premium of the range, and then expand lower. Okay, so this is all you need to utilize, right? Now, I'm gonna go back over here to what we had here. This is the example for the 4 hour. And this is the written of the previous example I showed you about the daily cycle sequential S&T 4-hour swing 15-minute PSP. You don't have to follow this model exactly with the 15-minute PSP. Once you rate above the 4-hour high, any time frame would validate. Honestly, don't go another 1 minute, right? Let's be logical here. The 15-second or the 5 seconds are not gonna get you a better entry. Stay on the 1 minute, reference all this, utilize it, and then let the higher time frame cracks and correlation and the swing divergence do all the work. You get your entry on the lower time frame, and then you take it to your draw liquidity. Guys, it's a super simple model. You simply just have to go ahead and execute. That's all you have to do. All right. Hope you guys enjoyed. I'll go ahead and see you guys later if there's any questions. Stay safe, much love, and peace out.